because ultimately I think they're just going to curtail issuance so greatly, and there's like this mindless bid for duration of whatever it is, 400 billion a year, 500 billion a year from duration matching. I could see that. And that's essentially de facto yield curve control. With the dollar weakening that much, it's going to be massively stimulative. Nominal GDP is probably pretty good. How they reinvest depends. How our foreign partners reinvest, it depends. I could see that. That's if he gets his 1%, yeah, that's what I would say. I'd say 1% Fed funds. I'd say, what would I say, 2.5 to 3 10-year, and $7,000 to $10,000 gold, and 75 to 85 Dixie. I'm of a couple different minds. My base case is that we've seen this pattern where sort of gold goes and then Bitcoin goes and then gold goes and then Bitcoin goes in the last few years, and I think it's maybe that. I also think part of it is, particularly amongst shorter term traders, Bitcoin is traded with Nasdaq increasingly in the short term, and the Nasdaq for a number of different reasons has kind of been range bound through much of the summer. And I think there are there's reasons to be potentially secularly concerned with the Nasdaq or certain high-flying parts of it, right? Can China win in AI, right? Right now, someone showed me an AI leaderboard the other day, someone in that world, and they said, hey, for what it's worth, this is based on what are supposed to be objective metrics. Top 10 AI platforms, half of them are Chinese, half of them are American, right? So you're spending hundreds of billions of dollars in capital in this country to build that out. What happens if China does to AI and the Nasdaq what it's done to sort of every other industry in the U.S. that it has attempted to do that to? I suspect some concerns around that, some concerns around the capital intensity, etc., are weighing on the Nasdaq. Some of the trade war has as well. So I think in the short run, some of what is holding Bitcoin back has just been that that short-term view that, well, Bitcoin is just Nasdaq, a high beta version of Nasdaq, up or down. And so if Nasdaq's not ripping, there's no reason for me to get involved in Bitcoin. And, there's something to that. Over time, of course, if you go back 5 years, 10 years, they are still they rhyme, but Bitcoin has crushed Nasdaq, right? So, and I still think that'll be the case. But I think those are kind of, and I guess I would layer on one last one, which is, we're to the end of the 4-year cycle on Bitcoin, right? So, 4 years ago was end of 21. We sort of had that last little blip up into the 60,000 range. And then, 2022 was sort of, kicking the crotch after kicking the crotch for Bitcoin holders. And 2017 into 2018, same thing. 2013, 2014, same thing. So I think there's a lot of people that are very cognizant of that and are skeptical that it's different this time. And I think that's a reasonable view. So I think sort of the combination of all those three things are probably, drivers to the reason why Bitcoin doesn't seem to be responding. Let's see. I'm still seeing, I would feel a lot worse about Bitcoin sort of being range bound if I was seeing people telling me, what I'm saying, which is they're going to have to repress this thing so much. And there's no way they're going to be able to win against China without running this thing super hot. I'm not seeing that. I'm still seeing a lot of bargaining and wishful thinking and sort of, idea machine, as one of my friends calls it, right? It's like, well, we'll just, we're going to mine all our mines. It's like, okay, great. Where are you going to get the turbines? We don't know. Well, the lead time on turbines is 3 years. Okay, well, how about the permitting? Well, we're going to get that. That's normally 4 to 5 years. Oh, okay, well, we're going to build a rail yard into those mountains. Great. Where are we getting the steel? Where are we getting the welders? Where are we getting the engineers? Are we going to take them off the AI programs? Or are we going to leave them on the AI program and bring in foreigners that you just close the border on? So there's a lot of the idea how to do it. That part's easy. There's an executional side that is being sort of, smoothed over by Washington and Wall Street that I would sort of summarize as, other than that, how was the play, Mrs. Lincoln, right?
Right.
Other than the fact your husband was assassinated at the play, how was it? Well,
Great.
That's the whole friggin' thing, right? That's,
Yeah.
If you can't execute and put this order of operations together, so let's see how that plays out. When it comes out, and I think it is a win, when it comes out that this isn't going to get fixed in a year or 2 or 3 years or 4 years, that this is, hey, we're going to need to do 10 years of really aggressive investing in inflation. Look, if Bitcoin's down or doesn't do anything on that, that's probably going to force a rethink on my part and a lot of people's parts. But
Right.
until I see people telling me that, I remain bullish.
Well, to your point about it sort of trading with Nasdaq and looking at it as sort of like the speculative play, I mean, JP Morgan came out a few weeks ago and called it the debasement trade, talking about gold and Bitcoin being at the safe haven from debasement. So rather than sort of people looking at it more speculative, it seems like mainstream or TradFi is coming around to it being more of that safe haven asset.
Yeah, I think that's right. And, I think it's an important sort of signpost, as I like to call them, along the way of, we've gone from traditional finance saying it's, whatever, rat poison and whatever they want to
Yeah.
call it, a Ponzi, what have you. Now it's part of the debasement trade. I think that's a huge step.
Yeah.
I don't think it's far enough, because I think ultimately where we are, there's no debasement trade. This is a debasement trend. We are into fiscal dominance. The Fed is running its first quasi-fiscal deficit, which is just a fancy way of saying operating loss, in its 110-year history. Once Brazil started running quasi-fiscal deficits, once Argentina started running quasi-fiscal deficits, gold and Bitcoin went from sell the rip, debasement trades, to buy the dips, debasement trends. And
Right.
I think that's sort of where we are, where there's still this view is like, okay, well, I'm going to have to get out and at some point and, sell Bitcoin, sell gold for dollars. And yeah, for a trade, sure. But like, really? You want to sell gold and Bitcoin for dollars as we're talking like into this setup? Like, why? Like, it makes no sense to me. And so I think that's still on the come. People will come to that.
Behind the charts lies a deeper unease surrounding major technology stocks. The AI race has intensified global competition, and recent performance leaderboards now show China and the United States running nearly neck and neck, split across world-class AI models. Still, questions linger. Can China replicate its successes in manufacturing, solar, batteries, and 5G infrastructure within artificial intelligence? The sheer capital intensity fueling U.S. AI expansion, projected to surpass $500 billion annually in combined public and private expenditure, has exposed vulnerabilities, including long supply chains for turbines, semiconductors, steel, and engineering talent. These pressures have quietly weighed on Nasdaq valuations.
I've not looked into it a lot. I should. That kind of thing would make a lot of sense if you can sort of, engineer that into an instrument. That would be very good for Bitcoin demand, obviously, and would help people in that position, right? Where, because you've got retirees who own a disproportionate percentage of those 300 billion or 300 trillion, or whatever, bonds. And, the other side of that is, here in the U.S. alone, they're the ones owed $120 trillion in Social Security, Medicare, Medicaid, right? So you're making repressing them is making the people who owe the money. And yes, they've paid into it, but they haven't paid in enough for what they're taking out. Otherwise, it wouldn't be blowing up. It's basically a tax increase on the people who are using the goods. The challenge is that, if they have to start selling stocks to pay for that, the stocks de facto back the treasury market through the government receipt and the consumer spending. So that you can't have them sell down stocks to help fund that. You've got to keep all assets up, or else the whole thing comes unwound. But yeah, in theory, something like that would help. I just haven't dug into it as much.
A single month of lower federal spending once triggered shockwaves across markets. In September 2025, government outlays dropped sharply, while officials promoted temporary budget surpluses aided by massive accounting reversals rather than real cash discipline. If such cuts continued, the economy could face contraction rivaling or surpassing historic crises like the GFC or the pandemic shock. The Nasdaq stagnation reinforced the belief among traders that Bitcoin can only break out when tech momentum accelerates. High beta narratives dominate short horizons, overshadowing broader fundamentals. The result? Sentiment paralysis, not asset irrelevance.
I think one of the wiser allocations I've seen, it was something inspired by a man named Jacob Fugger, F-U-G-G-E-R. I think he was Dutch. Way back in sometime in the Middle Ages, he was a merchant. And by share of the economy, he was one of, if not the wealthiest man in history. And what he advocated was 25% gold, 25% cash, 25% real estate, productive real estate, which, farms, timberland, etc. And then 25% I think he said government bonds technically. I would put that not in government bonds, but I would put that in high dividend, dividend paying blue chip equities, and then rebalance when you need to rebalance. And I would say of the 25% in gold, I would split that with Bitcoin depending on your age. If you're younger, I would probably and have more of a tolerance for higher volatility. I would probably have a high, more than half of that in Bitcoin and smaller in gold. And if you're older and closer to retirement and less of a stomach for volatility, I would have that more in gold and less in Bitcoin, maybe just a sliver in Bitcoin, capture and participate some of that upside. And if I was older and closer to retirement, I would probably put some of the 25% that are in equities and put them into, some portion I would put into high grade corporate bonds. I wouldn't put them in long-term government bonds. I just think I would much rather have, I think at some point in this cycle, you will see high grade U.S. corporate bonds trade through, as they would say, similar tenor government bonds. I'd rather own a Microsoft bond than a U.S. Treasury. They're both going to get paid. I just think it's I think that's how they're going to trade. So that's what I would do. And, Ray Dalio's all-weather portfolio was inspired by Fugger's allocation. But I think the key is really having balance because we are just off the reservation in a number of different directions. I mean, this could break severely deflationary. It could break severely inflationary. It could not break. It could muddle through. It could, there's if anybody tells you they know how this is going to go, like run in the other direction. And certainly me, like I am no seer. Like I don't know how it's going to go. I want to have sort of balance across that. So that informs some of how I'm positioned. And I think it's a wise allocation for the world as it is today.
How could it break deflationary?
For deflationary?
I don't know. To deflationary. I don't know if there's any precedents ever that I've ever seen where a government says, well, it was a good run, pack it up, boys, let's just stop. Right? I've never seen that. Every nation takes it until it doesn't work anymore, right? Diminishing return. So what would it look like for to break deflationary?
For it to really break deflationary, to your point, it has been the most rarest of things, and it's only been temporary. When you control the currency, when you print the currency, they never choose deflation. It would have to be some sort of, pandemic / die-off, probably, right? Where, there just isn't not only there isn't the demand, but there isn't a productivity driver to accelerate relative to that, right? I'm trying to think through this on the fly, but if you have population decline but productivity advances faster, then you can in theory improve living standards, but I'm not even sure that's the case. I'm thinking back to like the Great Plague, right? A quarter of the population in Europe, or 30%, died. Yes, you were probably on some sort of gold standard. I'm not that familiar with it, or metallic standard. At any rate, you end up with a deflationary scenario where, but even then, certain things, right? It was deflationary for the landlords and their properties and houses and rental rates, but it was very inflationary for labor, right? Labor all of a sudden had power. It was margin compressed. So,
because
to your point, it's very difficult unless the government just stands aside and just says, yeah, we're defaulting and have a good day. But even then, that's only going to be for a bit because the debt backs the currency. So it's only going to be for a little bit, and then you're going to have hyperinflation.
The Federal Reserve presents a paradox, operationally insulated yet shaped by political appointments from the executive branch. Analysts interacting with regional Fed staff describe a quiet institutional concern for defending dollar stability, often believing they stand alone against fiscal pressures from Congress and public debt servicing. However, recent leadership behaviors have leaned more politically responsive, signaling a shift from monetary caution to strategic signaling. Unlike past eras where aggressive tightening proved decisive, today's policy discussions unfold under a towering debt burden, where credibility depends as much on global perception as interest rate arithmetic.
I think that's right. It's interesting when you bring it up that way. The U.S. government spent 43% less in September than it did on average the prior 11 months, right? So it spent $346 billion versus an average of $603 billion a month of outlays the prior 11 months of fiscal 2025. And of course, Scott Bessent got on X and bragged about his $198 billion surplus, which was aided by a $107 billion negative outlay, which I think was a reversal of an education, a student loan accrual. But I would love to pay my taxes with a negative outlay. That would be fun. Like, I'll just send you guys a negative outlay and don't touch my bank account, non-cash.
Yeah.
But the point here is that 43% decline in outlays, if it was continued for another few months, would be catastrophic. It would be catastrophically deflationary. What's really interesting in this is the 10-year Treasury, with that amount of a monthly decline in outlays, that it only went from 4.25 to 3.95 or 3.97. Like, that's really something. That's actually very troubling. Like, if I owned long-term treasuries and they could cut spending for a month by 43% and all I got out of it were 30 friggin' basis points on the downside, that's not really encouraging. I mean, that really speaks to your point on fiscal dominance. So, look, maybe if they kept doing it for another month or two, maybe they could get the yields down a bit more. Maybe it would definitely be deflationary. But then again, because the federal government is 23% of GDP, the federal outlays divided by GDP is 23%. So you cut that by 40% for a few months, you're going to be running GDP down 9 to 10% on a run rate basis. By way of comparison, the full year GFC was down 3 or 4. By way of comparison, shutting down the economy for COVID, it was down like 8.5. So you would be like literally tanking the economy. So you could do that for a second until, you would run into what we've run into, which is the Treasury market dysfunction. Yields will start going up in a recessionary environment, and then they're in a death spiral. And then to your point, like, what do you want to do? You want to stand aside and just let this thing go into the ground at 500 miles an hour? Okay, but that's never how it works out. They come in and, they print the money one way or another.
History doesn't repeat, but patterns rhyme. Every major Bitcoin cycle has faced a brutal digest phase roughly a year after euphoric highs, 2014, 2018, 2022, and 2026 carries resonance with that legacy. Markets often recoil where optimism meets execution doubt. The hesitation today mirrors past investor skepticism that this time is different. Large portfolio holders have used periods of heavy liquidity to de-risk without abandoning conviction, trimming exposure amid surging volumes. Cycles cleanse participants, reward patience, and punish emotional fragility. Temporary price compression often reflects memory of past pain more than present weakness.
If he gets rates, you're talking about Fed funds rates. If he gets Fed funds at 1, could get that. I wouldn't be surprised if he got that. To me, the $64,000 question then is, where's DXY? Where's gold? Where's a 10-year? If he has rates at 1 by the end of his term, I think DXY's low 80s, high 70s. And I think the 10-year, I think gold is probably $7,000 to $10,000 an ounce.
Wow.
I think Bessent has revalued it from 42 to whatever that number is and put multiple trillions of dollars into, $1.5 to $2 trillion, maybe up to $2.5 trillion into the Treasury General account, and significantly curtailed long-term Treasury issuance. So I think the 10-year, if Trump gets his 1%, I think DXY's, 75 to 85, and I think gold's 7 to 10,000, and I think the 10-year yield is at, where is it today? 4? I bet you the 10 years at 2.5, 3, because ultimately I think they're just going to curtail issuance so greatly, and there's like this mindless bid for duration of whatever it is, 400 billion a year, 500 billion a year from duration matching. I could see that. And that's essentially de facto yield curve control. With the dollar weakening that much, it's going to be massively stimulative. Nominal GDP is probably pretty good. How they reinvest depends. How our foreign partners reinvest, it depends. I could see that. That's if he gets his 1%, yeah, that's what I would say. I'd say 1% Fed funds. I'd say, what would I say, 2.5 to 3 10-year, and $7,000 to $10,000 gold, and 75 to 85 Dixie.
In a world shaped by fiscal dominance, investors debate assets as trades instead of long-duration realities. Classic portfolio frameworks from early merchant investor principles, holding hard currency hedges, land assets, productive real estate, liquidity buffers, and dividend equities, have modern relevance. Strategic longevity matters more than timing perfection. Today's challenge isn't choosing growth versus safety, but surviving both inflationary and deflationary shocks without conviction collapse. Resilience beckons disciplined allocation, periodic rebalancing, and clarity that wealth protection is a long arc strategy, not a seasonal debate.